It's 11:59 p.m. on December 31st. With just days left in 2025, your entire year's tax outcome is about to lock in. Most business owners miss this. Some tax moves cannot be fixed in January. Miss them, and you could permanently lose tens of thousands in real savings.
Wait, this isn't fixable in April with my accountant?
No, April is filing. December is planning, and proper planning can save $80,000 or more. Quick disclaimer, this is education only. Always consult your CPA. Let's rewind and explain why December 31st matters more than April 15th. I'm Ivy, your digital tax pro at Ivy Smart Tax. We review hundreds of IRS audit cases every year. This comes straight from the rulebook.
The no BS version?
Exactly. The biggest mistake? Thinking April 15th is the deadline. April is just reporting what already happened. December 31st decides your tax reality for most profitable small business owners, consultants, and founders. Once January 1st hits, the year locks. No retroactive purchases. No retroactive plans. No retroactive structures.
So January is already too late?
For most high-impact strategies, yes. This isn't fear-based advice. It's about control. Panic spending triggers audits. Real tax planning is intentional and documented. Plot twist, the biggest tax savings often don't require spending more money. They come from timing, classification, and structure. Pause here. Everything ahead fits into just 4 buckets. Master these, and you capture about 80% of legitimate year-end savings. Here they are: equipment and assets, retirement plans, income and expense timing, entity and election decisions. Most businesses save the biggest money in one of these, not all 4. Bucket 1, equipment and assets. Under OBBBA, 100% bonus depreciation is now permanent. But timing matters. The asset must be acquired after January 19th, 2025 and placed in service by December 31st. Delivered and operational by year end, that's often a full deduction.
So delivery really matters?
Absolutely. And here's why. That's often a full deduction. The IRS doesn't care when you pay. They care when the asset is placed in service. That means 3 things: acquired, available for use, and actually used in the business. Miss any one of those, and the deduction doesn't exist. Here's a real-world scenario we see every December. A business orders $120,000 of equipment on December 28th, paid in full, but delivery happens January 3rd. Result? 0 deduction in 2025. That 6-figure write-off legally shifts to next year. No exceptions.
So the difference can literally be a few days?
Sometimes just hours. Now compare that to the correct version. Same purchase. Delivered December 30th. Installed. Actually used before year end. That's a full deduction. Locked in. And many businesses miss another major category here, R&D. Starting 2025, domestic research and development costs are immediately deductible again. No more forced amortization. Some businesses may even be able to amend prior years for refunds, but only if the activity qualifies and is documented properly.
So luxury cars always work for bonus depreciation, right?
Myth. Only qualifying vehicles with legitimate business use and proper documentation qualifies. Misusing vehicle deductions is one of the fastest ways to trigger an audit. Bonus depreciation is powerful, but only when it's intentional, compliant, and provable. Bucket 2, retirement. And this is where many business owners get confused. Let's break it down clearly. SEP IRA is simple. You can establish and fund it up to the tax filing deadline, even into 2026. Solo 401k is more powerful, with higher contribution limits, but it must be established by December 31st.
So SEP is flexible, but solo needs action now?
Exactly. And this is the mistake we see every single year. Business owners wait until tax season, then realize the solo 401k option is already gone. Here's the shortcut. If income is unpredictable, SEP may be safer. If income is strong and consistent, solo 401k usually wins. But here's the IRS rule that matters most. Funding timing is flexible. Plan existence is not.
So even if I have the money later, I still need the plan now?
Correct. No plan on December 31st means no solo 401k, period. Example, a consultant earns $250,000 in 2025. In March, they want to shelter income using a solo 401k. But the plan wasn't set up by December 31st. Result, they're locked out, even though the cash is there. One more thing many owners overlook. New retirement plans may qualify for up to a $5,000 startup tax credit for 3 years, helping offset setup and admin costs. That credit only applies if the plan is properly established. Retirement planning isn't about picking the best plan. It's about picking the right plan, on time. Bucket 3, timing. And this applies mainly to cash basis businesses. Here's the rule. Cash basis means income is taxed when received, and expenses are deducted when paid. That's why timing works, if done correctly. For cash basis businesses, you may be able to delay invoices where appropriate, prepay certain expenses like rent, insurance, or supplies, up to 12 months. Bonuses, they're deductible only if actually paid by December 31st.
That helps with retention too.
Exactly, if it follows the rules. These strategies do not work the same way for accrual basis businesses. Applying cash rules to accrual books is one of the most common IRS audit findings. Pass-through owners should also review PTET. Authorization is not payment, and intent is not payment. For a federal deduction, state entity-level taxes must leave the bank account by December 31st. Timing is powerful, but only when it's deliberate, documented, and compliant. Bucket 4, entity and elections. This is where timing becomes legal reality. S-Corp elections, accounting method choices, and certain tax elections must exist in 2025 to matter for 2025. There is no backdating reality. Now here's the nuance many people miss. The IRS does care about intent, but intent must be documented. Emails, signed elections, filed forms, consistent reporting. Undocumented intent doesn't count. Thinking about it doesn't count. Talking about it doesn't count. And putting it in your notes app definitely doesn't count. If an S-Corp election wasn't filed on time, you can't just say you meant to be an S-Corp. If an accounting method wasn't adopted and documented, you don't get to apply it retroactively. This is why entity planning must happen before year end, with paperwork, timestamps, and consistency. Because in tax law, if it's not documented, it didn't happen. Same business, same income. One planned by December 31st and saved over $80,000. That difference compounds every year.
What happens when this is done wrong?
That's exactly what our audit cases reveal. 5 reminders. December 31st is the action deadline. Post-Jan 19 plus delivery matters for 100% bonus. Retirement plans must exist by year end. Timing and PET must follow strict rules. And no backdating. Even if you missed some of this, understanding the rules now changes future years. Comment, equipment, retirement, timing, or entity. I read everyone. If this clarified why year-end planning matters, subscribe and turn on notifications. We share CPA-guided deep dives, case studies, audit risk breakdowns, and tax insights to help you stay ahead.